Hey everybody, welcome to the channel. Soil here, and today I want to talk about three important facts about candlesticks that you should know. Probably you know how to analyze candlestick charts and you're familiar with different types of candles and candlestick patterns, but in this video, we're going to see what is hiding inside a candlestick and how we can extract more information from them about market sentiment. If you're not familiar with candlestick patterns and how to analyze them, I have complete guides and tutorials on this subject. The links are in the description of this video, and I recommend you to watch them later, even to those of you already familiar with this, because definitely you'll find some useful information in them. Alright, let's begin with fact number one, unwrapping a candlestick. As you know, a candlestick or combination of more than one candlestick give us information about price action within the time frame that you selected for your chart. For example, right now, the time frame is 4 hours, and this candle is giving us information about price action in this 4 hours. This is a cross doji candle, and it's naturally bullish, meaning it gives us the possibility that the price may advance after this. If we look at this time period in a lower time frame, exactly this 4 hours on a lower time frame, for example 15 minutes, this is what we have. All these candles and price actions are happen in that one candle that we had, and now we can better analyze the market sentiment. The first half is actually declining of the price, and it's clearly showing that traders who had the asset and had long position couldn't take the pain of loss anymore, and they were closing their positions. And also on the other hand, we had traders who were late for entering in this trend, and they were opening short positions. These last sellers then shortly realized they were wrong and they are on a losing side, so they needed to close their short positions, which means they have to buy, and this caused increasing of bullish pressure. And also those who had long and closed their positions here, some of them when see the price is moving up without them, they enter a long position again in the hope of covering some losses. And you can see how in this period the bulls took the control and how the buying pressure outweighs the selling pressure right now. So always remember, by unwrapping a candle or candlestick pattern and analyzing it in lower time frames, you can better identify the changes in market sentiment and possible next moves. Fact number two, impulse or correction. The market is always in two conditions, either trending or not trending. And when the market is trending, there are only two stages in the market, impulses and corrections of previous impulses. So when the market is in an uptrend, we have upside impulse and then correction, and this repeats over time. And when the market is in a downtrend, downside impulse and then correction. Impulses actually make trends, they break resistances or supports, and they move with a clear direction. But on the other hand, corrections lack direction and they move in ranges and usually retraces some or maybe all of the advances of the previous impulse. Many traders think that a trend is made based on many candlesticks because they've always looked at a trend in this way, but you must pay attention that you have defined a time frame for your chart. And based on what I have explained in fact number one, the whole trend can be considered just a one candlestick in higher time frame. So there is no surprise to have an impulse or correction summarized in a single candlestick, because if you look at that exact time in shorter time frames, you will have a collection of candles that show the price action pretty well. So a candlestick with a large body and in the ideal situation almost no shadows can represent an impulse. There can also be shadows of considerable size, so we must be flexible on this. Actually analyzing shorter time frames can help us to better understand the market sentiment, as I explained in fact number one. And small body candles usually with shadows show corrections. They can also be without shadow and still show corrections. Always remember, when it comes to patterns, don't look for perfect shape and size. And when we're talking about these patterns, we're just talking about possibilities, and they must be used in conjunction with other tools and aspects of technical analysis. And the fact number three, who is in control, bulls or bears? Besides the patterns and types of candles that can give us some clues on who has the control, the shadows or wicks can also help us to evaluate the buying or selling pressure and find out who has the control. Actually, here we're talking about two or more candles with long shadows that form in turning points of the market, and they show rejection of prices in those high or low levels. If you see several candles with large lower shadows that form somewhere in the bottom of the market, such as a support level, this is a strong signal that those low prices are rejected and the buyers are pushing the price up, and there is a high probability to see advancing of the price. And when we have these large shadows in top, for example, near a resistance level, this indicates that those high prices are rejected and sellers are pushing the price down, and it's very probable to see declining of the price. Please pay attention that you should never take your trading decisions only based on candlestick patterns, and they must be used in conjunction with other tools and aspects of technical analysis. Alright, that's it. Thank you for watching this video. If you have any questions, feel free to ask and leave a comment for me. I'll answer your questions as soon as possible. If you found any value in this video, please like it. Please subscribe to my channel if you haven't already, and hit the bell so you get the notifications of my new videos. See you guys in next video, and good luck with your trading.